Hi class, welcome to our next topic, ASR09, completing the audit. So in this phase of the audit, we perform procedures to wrap up the procedures that we have performed and to take note whether our conclusions are supported by sufficient and appropriate evidence. Our references for this topic include number one, we have PSA 330. So our responses to assess risk of material misstatement. We also have PSA 500 on audit evidence, PSA 520 on analytical procedures, PSA 560 subsequent events, PSA 570 going concern, PSA 580 written representations, and PSA 720 our responsibility in relation to other information in documents that comes together with the audited financial statements. So again, completing the audit. On this part of the audit, we wrap up the engagement. So by performing additional procedures to identify any issue or matter which we did not separately address during our performance of specific substantive tests. So usually those areas related to presentation and disclosure, so we cover here in this phase of the audit. So although remember, our procedures related to, let's say, validating or reviewing the disclosures of the client are already incorporated in our substantive test procedures. However, there are certain items that were not separately addressed during the performance of substantive test. So that is why we use this opportunity and this part of the audit to address or to consider those areas. So especially if the items are not recognized in the financial statements and yet they are needed to be included in the notes in the note disclosures to the financial statements. So because if they are not recognized in the financial statements, like for example, commitments and contingencies, most likely we were not able to address them separately when we perform our substantive test because during the substantive test procedures, we focus on items that are recognized or presented in the financial statements. Here are the procedures that we perform during the completion phase of the audit. So we perform final analytical review. So remember, final analytical review is required under our standard to be performed during this part of the audit. So when we perform final analytical review, we determine whether our conclusions reached are aligned with the audit evidence that we have obtained. So we can perform those types of procedures that we discussed before, like for example, test of reasonableness and comparing the figures, final figures now compared with the prior figures, whether the significant differences are properly accounted for. So as part of our final analytical review. Okay, so because remember, analytical procedures are performed thrice in an audit during the planning phase, during the substantive audit procedures phase, and during the completion phase. And it is required during the planning phase, the risk assessment phase, and at the completion stage. So this is the completion stage. This is another instance where it is required to be performed. Okay? Then we also have to understand commitments and contingencies that may affect the financial statements. So because remember, some of these commitments and contingencies were not addressed separately during the substantive procedure phase for the reason that some of them are not required to be recognized in the financial statements like contingent liabilities. However, they are required to be disclosed in the financial statements of our client. So we have to review whether those contingencies are properly captured in the financial statements of our client. So we also perform review of subsequent events, those that occurred between the financial statement date and the date of the auditor's report. So another procedure is evaluating the management going concern. So because going concern is a very pervasive assumption in the preparation of financial statements of our clients. We also identify related parties and related party transaction. So also part of the disclosures in the financial statements of our client. And finally, obtaining management representation letter. So as mentioned earlier, so some commitment and contingencies may not be recognized in the financial statement. So especially if they do not fall under the criteria or definition of being a provision, so most likely they will not be recognized in the financial statements. So that is why uh, we might not have covered them or addressed them separately during the performance of the substantive phase of the audit. So because our substantive procedures would be limited to items that are recognized in the financial statements. However, those some of those commitments and contingencies are required to be disclosed in the financial statement, especially with respect to contingent liabilities. So that is why we perform procedures to understand and to identify whether there are additional commitments and contingencies while not recognized in the financial statements of our client but needed to be disclosed in the notes to financial statements. So in performing procedures to understand and identify commitment and contingencies, so the following procedures may be performed by the auditor. So number one, we may inquire with management and those charged with governance with transactions or events that could give rise to commitments and contingencies that are required to be disclosed in the financial statements of the client. Now, like for example, if they guaranteed another company, if there is litigations or cases that could give rise to contingent liabilities, so we ask them from the management and those charged with governance. So we can also read permanent files such as corporate records, so client communication and minutes of meetings of the board of directors and shareholders meeting to identify if there are significant events that could warrant disclosure in the notes of financial statements of our client and to determine whether they are uh, captured by the client in their note disclosure. We also send confirmation with the legal counsel, so especially about the status of cases or litigation that our client might involve in. So because they can give rise to information that could warrant disclosure in the notes to financial statements of our client. So we also test professional fees account. Now, this is different from the substantive audit procedures wherein we validated the amounts recorded related to professional fees. In this part of the audit, we are testing professional fees account to determine whether they have consulted with various professionals and the reason why they consulted those professionals. So like for example, if the client paid professional fees to lawyers, so other than the usual retainer, for example, so we might ask the management, so what is the reason why they paid certain lawyers or consultants? Because those might relate to transactions that could warrant disclosure in the notes to financial statements. So we also test the reasonableness of the accounting estimates made by management, okay, or emanating from the judgment of the management to determine whether they are fairly presented in the notes to financial statements. In fact, in the financial statements of our client, there's a separate section in the notes to financial statements explaining the significant accounting policies and judgment so made by the management related to their financial statements. So we can also review current file for any indication of commitments and contingencies. So like for example, our confirmation with banks and other financial institutions. So that could provide information to potential commitment and contingencies that could require disclosure in the financial statements. And then this one, we can also read relevant news about the company. So publication from relevant news sources and sites. So could provide information whether, for example, there are recent events that could affect the company. Now, like for example, litigation or negative publicity that could affect the company. So those events, no, or some of those events could warrant disclosure in the financial statement. So that is why we also consider them. Next, another procedure we perform during the completion phase of the audit is reviewing subsequent events. So subsequent events are events that occur between the date of the financial statement, no, statement of financial position date, up to the date of the auditor's report. Okay, so the period between the date of the financial statement and the date of the auditor's report are referred to as subsequent events. With respect to auditors' responsibility related to subsequent events, because remember, so our responsibility is to audit the financial statements, and the coverage of the financial statements is from January 1 to December 31 for a calendar year client. However, the auditor should also perform audit procedures after the balance sheet date or statement of financial position date and up to the date of the auditor's report to identify any potential effects of subsequent events to the financial statements covering from January 1 to December 31, for example. So in case of calendar year clients. Now, after the auditor's report date, the auditor has no responsibility anymore to perform procedures so related to events after the date of the auditor's report. But the management has responsibility to inform the auditor of any facts which may affect the financial statements after the date of our auditor's report. So in our audit report discussion, we will discuss what would be the effect of this information or facts after the auditor's report date and how they can affect our audit report related to the financial statements of our client. So because our primary responsibility is to perform procedures only from the SFP date up to the date of the auditor's report. So some of the procedures that we perform related to subsequent events include the following. So first, we obtain understanding of the process of the management in identifying the subsequent events. Next is we inquire the management and those charged with governance, so with respect to subsequent events that could affect the financial statements of our clients. So we read the minutes of meetings of board of directors and shareholders. So take note, these minutes of meetings would cover from the date of financial position, December 31, for example, up to the date of auditor's report. So meaning to say, our procedures to read the minutes of meetings of the board of directors and or shareholders would not only cover the period of financial statements from January 1 to December 31. So but also from period December 31, the date of the financial position, up to the date of the auditor's report for any subsequent event. So we can also read the latest interim financial reports of the client, for example, quarterly financial statements after year end. So their budgets, forecast, and other management report. So to determine whether there are any information that could still affect the current financial statements under audit. Okay, so similar also with the previous procedure. So we can also inquire from the legal counsel, send confirmation with the legal counsel, so to determine if any subsequent event could have an impact on the financial statements of our client. So we will discuss more about subsequent events when we go to the discussion of the auditor's report. So because there's a different type of subsequent event, we have adjusting event and we have non-adjusting event. So we will understand their implication in the audit report in our discussion of audit reports. So which is the module after this one. So next, another procedure that we perform during the completion phase of the audit is evaluating the going concern of our client. So this is a very important assumption, a very pervasive assumption with respect to the financial statements of our client. So that's why it's mentioned here, the going concern assumption is a fundamental principle in the preparation of the financial statements. So because if the client is not going concern anymore, then they should prepare their financial statements under a different basis. They cannot prepare their financial statements using the going concern basis, okay, but rather liquidating basis. So that could have a pervasive or very significant effect on how the financial statements are prepared and presented. Now, an entity or a company is ordinarily viewed as continuing in business for the foreseeable future with neither the intention nor the necessity of liquidation, ceasing trading, or seeking protection from creditors pursuant to laws and regulation. So that is why we make an assessment from the date of the balance sheet date, SFP date, December 31, and 12 months thereafter, so to assess if the client can operate or does not have the necessity to liquidate during that period, for the purpose of issuing an opinion on their December 31 financial statements, for example, or year-end financial statements, and for information that we might need to include in our auditor's report. So that the assessment or the period of assessment that we make related to the client's ability to continue as a going concern is within 12 months from the balance sheet date or statement of financial position date. So our procedures include obtaining sufficient and appropriate evidence about the appropriateness of the management use of the going concern assumption. We conclude, based on audit evidence obtained, whether there is material uncertainty that exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. So because we have to include that in our report if there is a material uncertainty, so related to the ability of the entity to continue as a going concern. And we will determine the effect on our audit report. So we will discuss more of this when we proceed to our discussion of audit report. Okay? But take note that in performing audit procedures related to going concern, we do not necessarily need to perform audit procedures solely to detect going concern problems. Our procedures to detect going concern problems of the client are already incorporated in our usual audit procedures or in our regular audit procedures in auditing the accounts and transactions of our client during the substantive test procedures phase of the audit. So therefore, we evaluate the effect of transactions and events that have been identified in performing regular procedures during the audit. And from the result of those audit procedures, we evaluate the going concern assumption of the client, whether there are transactions and events that could affect the appropriateness of the management's assumption on the use of going concern. So meaning to say, we do not perform a specific procedure or separate procedure to identify any going concern problem on our client's financial statements. No, but rather, as a result of our regular audit procedures, from there, we can already conclude whether there are any events or transaction that could cast significant doubt on the entity's ability to continue as a going concern. So that is why some of the procedures that we perform include identifying indicators of going concern issues based on the results of our audit procedures designed to accomplish other audit objectives. And if there are indicators of going concern, then that's the time that we can perform additional audit procedures. Like for example, the use of models. So one popular model is the Altman Z-score model. So wherein it is a numerical measurement that is used to predict chances of bankruptcy. And bankruptcy could affect the going concern assumption of the client. So meaning the chance of the client being bankrupt could impact the ability of the entity to continue as a going concern. Now, this model uses a number of different ratios to predict the chances of a company in going to bankruptcy. Okay, and this model has a very high accuracy rate. So in practice, so that is why it is useful for auditors in evaluating the going concern of the client. So in case there are indicators that you have seen when you perform your regular audit procedures. Now, if condition and events, such those identified previously, create substantial doubt as to the ability of the entity or company to continue as a going concern, we consider whether the management has plans and ability to mitigate the effects of such events or conditions. So, like for example, the client lost a major customer. Okay, then we have to inquire from the management. So, what are their plans and whether they have the ability to mitigate the effect of loss of such customer. So because that is important in our evaluation of their going concern assumption. Now, if after the management told us their plans and their courses of action to mitigate the effect of such event and condition, and there is still remain a doubt on the ability of the client to stay going concern, we have to evaluate whether that matter is adequately disclosed in their financial statements and to determine the impact in the auditor's report. Okay, so because if there is substantial doubt as to the ability of the entity to continue as a going concern, it will have an effect on the content of our audit report. So once again, we will discuss more of this concept when we go to our discussion of audit reporting. Next, another item related to sufficiency of disclosures of the management with respect to their financial statements are those related to RPTs or related party transaction. So related parties are those companies that are affiliated with the company. So like for example, parent and subsidiary relationship. So significant influence like those investment in associates. So joint ventures. So including key management personnel and their family members. Now, it's the management who is responsible for identifying and ensuring sufficiency of disclosures related to RPTs or related party transactions in the financial statement. So, remember in our discussion during risk assessment, this is a source of significant risk. So, for the reason that number one, this is highly regulated. So we have the BIR, we have the SEC looking closely at the relationship of the company with their related parties. So take note that related party transactions or related parties are not illegal per se. So in fact, they are a normal feature of business. Okay, so it's a normal feature of business. So meaning there are companies that are affiliated with other companies. So that's possible and that's normal in our business scenario or in the commercial activities of the entity. So, but the problem is sometimes these related parties are sources of fraudulent transactions, or it provides opportunity for the entity to conduct irregular activities. So that is why sufficiency of disclosures are required by different government agencies. So not to mention that some of these transactions do not occur at arm's length transaction. Okay, so that is why appropriate disclosure should be included in the financial statements of a client whenever they have related party companies and or key management personnel, also part of related party, including their family members, and when they have transactions with these related parties, whether there is a price charge or none. So as auditor, our responsibility is to obtain sufficient and appropriate evidence so related to the related party disclosures, no, or related party transactions made by the company with these related parties. So to perform the procedure, so we inquire with the management so regarding the identity of the related parties, so including any changes in the period. So normally all related parties are required to be disclosed in the financial statements. So again, all related parties are required to be disclosed in the financial statements. But with respect to the transactions, what is required to be disclosed are material related party transactions. So that's the difference. So the client should disclose all of its related parties, its affiliated companies, including key management personnel. So, but with respect to related party transactions, so they need to disclose the material related party transactions only. So, the nature of the relationship between the entities, whether parent-subsidiary relationship, significant influence, or joint venture, and whether the entity entered into any transactions with these related parties during the period and if they entered the type and purposes of the transaction. Usually, there will be a tabular disclosure of that in the notes to financial statements of the client. So disclosing the amount of the transaction, the movement during the period, and the ending balances. So here are some indicators of the existence of related parties which could help us auditor in identifying the existence of related party transactions. So borrowing or lending at no interest or at rates significantly different from market rates as mentioned earlier. So many of these related party transactions are not done at arm's length. So that is why sufficient disclosures are required by our standard and regulatory bodies. So another sale rather of real estate at prices significantly different from the appraised value. So this could also indicate a related party transaction once we identify that during our audit. So exchanges of similar property in non-monetary transactions, so loans with no scheduled terms, so business with major customers and suppliers. No, it's possible that those major customers and suppliers could be related parties already. So services being provided or received at unreasonable prices. So accounting records for large and unusual transactions. So confirmations and invoices from lawyers. So these are some of the indicators that we can use now as red flags. So whether related party transactions actually occur. Okay, so because again, these are normal part or feature of the business, but what we need to determine is that whether they are sufficiently disclosed in the financial statements of the client. So other sources of evidence that we can use in identifying related parties, including bank and legal confirmation as obtained from our audit procedures. We also read the minutes of meetings of the shareholders, the board of directors, okay, bank and other board of board committees. So those minutes of meeting can also provide information about existence of related party and related party transaction. We could also look and review the findings of the client with the SEC, like for example, their general information sheet, conflict of interest statements, so pensions, other trust for key management personnel, including the identity of the officers, no, including their family members, so because they are considered also as part of the related parties. Then finally, another procedure that we perform during the completion phase is the obtaining of the management representation letter. So in this part of the audit, we should obtain evidence that the management acknowledges its responsibility for the fair presentation of the financial statements in accordance with the relevant financial reporting framework and that the management has approved the financial statements. So there are two important purposes of obtaining a management representation letter. So one, it provides evidence that the management acknowledges their responsibility over the financial statements. And number two, that the management has approved the financial statement. So this is different from the management letter that we have discussed during the I think preliminary engagement activities. Okay, so management letter is a letter prepared by the auditor and sent to the management, no, to provide the comments about the internal controls, deficiencies in internal controls that we have found during our procedures. Okay. On the other hand, management letter is something that will be coming from the management, signed by the management, expressly acknowledging their responsibility over the financial statements and approving the financial statements after our audit. Okay, after we have audited the financial statements, booked the adjustments, so they have approved the financial statements for issuance. Okay, so our procedure with respect to obtaining the management representation letter is to obtain minutes of BOD meeting, Board of Directors meeting, of the approval of the financial statement. So usually in one of the meetings of the Board of Directors after year end, they should adopt a resolution approving the financial statements after our audit. Okay? and we obtain written representation from management. So it's a letter. So it's a letter signed by the management acknowledging their responsibility over the financial statements. So we also should obtain signed copy of the financial statements. So usually the management will sign every page of the financial statements, so signifying that they have approved the financial statements. Apart from a statement of management responsibility, which is also included in the financial statement. So this is very important so that we have this reasonable assurance that the management is aware about their responsibilities with respect to the financial statements. In fact, in reality, we do not issue our audit report without obtaining the management representation letter. So that is why the date of the management representation letter would coincide also with the date of the auditor's report. Okay, and then upon provision of the auditor's report, we should also obtain from the client, from the management, their management representation letter. Okay. Now, take note that we obtain written representation from management where other audit evidence are not ordinarily available or cannot be expected to exist. So, meaning to say, management representation letter cannot be a substitute, no, to other audit evidence that we could reasonably expect to exist. Now, like for example, the auditor forgot to perform a procedure related to audit of receivable. So let's say the auditor forgot to confirm the receivable. So uh, can the auditor, what we call this, compensate that by asking representation from the client that during this part of the audit, the auditor will ask from the client, can you represent that the receivable is fairly stated because we were not able to confirm it with your customer? So is that a valid audit procedure? The answer is no. So we cannot ask written representation for an audit evidence that we could reasonably expect to be available. So normally, we limit the contents of the management representation letter to material items or significant items and where other audit evidence would not be available. So example of those would be, let's say, intentions, no? Or judgment or estimate coming from the management. So those significant judgment, significant estimate, or estimate based on intention, there are no other available evidence but representation from management. So we ask a written form of it in the form of the management representation letter. So therefore, written representation from management are limited to either individually or collectively material to the financial statements. So we do not try to include, no, all items when we ask management representation letter from our client. Okay? So usually the content of management representation letter are reviewed or drafted by the auditor, but it is accomplished by the client. Now, the approval of it, the signature of the client would be affixed on the management representation letter, so before it is provided to the auditor. And as mentioned earlier, that management representation letter is dated as of the same date of the audit report. And it's also possible that we can obtain a separate written representation after the date of our audit report when there are specific transactions or events necessitating a separate management representation letter. So like for example, the date of public offering, no, wherein let's say the client asks us to provide another report related to their public offering. So in that case, we need to obtain a separate management letter so related to that specific transaction, separate from the management letter that we have obtained during the regular conduct of the audit of the financial statements. And then finally, the management representation letter should be signed by the members of the management who have primary responsibility for the entity. Example of that would be chairman, chief executive officer or president, and one responsible for its financial aspects. For example, from treasurer, CFO or Chief Financial Officer or VP for Finance. So therefore, at a minimum, there are two responsible officers who should sign the management representation letter. One responsible for the overall uh, the primary responsibility for the overall conduct of the operations of the company, like the chairman or the president or the CEO, and another one responsible for the financial aspects, like the treasurer, the CFO, or the VP for finance. Now we have other completion procedures. So other completion procedures include the performing final analytical procedures we already discussed earlier. So in this final analytical procedures which is required, our final analytical review. So we take note whether our conclusion is supported or aligned with the procedures, findings, with the evidence that we have obtained thus far. So if the final figures, if the final amounts in the financial statements are reasonable already, so based on the procedures that we have performed. So we also review the working papers and draw conclusions on the results of our audit procedures. So we obtain approval of client, so regarding disclosures and audit adjustments. So these adjustments are only proposed by the auditor. The final approval should be made by the management. So we also evaluate the overall presentation of the financial statements, including the disclosures, and we review other information or documents containing the audited financial statements. A good example of which is the annual report of the client. So the annual report of the client will include the discussion of the management about the conduct of your operations in the prior year, okay, which may include the audited financial statements. So that is why we have to perform procedures not to ascertain whether the information in the financial statements are aligned with the information in that document. Because otherwise, if there would be an inconsistency or material inconsistency between the audited financial statements and the document, then we have to resolve that with the management. Okay, so before we issue our audit report, or if we have issued our audit report, there will be courses of action that we should perform in case there are material inconsistencies between the financial statements and the document containing the financial statements. And we'll discuss that in our next topic in the audit report. So that ends our discussion with respect to procedures to be performed on the completion of the audit.